Hello everyone and welcome back to the channel here. This is Cellular US Stocks and we cover everything related to US stocks and the financial market in the USA. So in today's video, we're going back to break down everything that happened in the financial markets last week, from the major index movement to the biggest drivers behind the volatility. We cover the performance of the major US indices, what caused the sell-off in global markets, the biggest news impacted technology stocks, key development in oil, inflation, and macroeconomics, and finally, the most important levels and themes investors should watch in the coming weeks. Last week was actually one of the most volatile weeks we've seen in months. Markets faced a combination of geopolitical tensions, rising oil prices, and weakening economic data, which triggered a clear risk-off sentiment across global markets. So, let's start with the bigger picture. Last week, the three major US indices all closed lower, from the S&P 500 here, as you can see. We can see that we start the week at 6,869 and we are at 6,632. So it fell about 4 to 5% on the last week, which is a significant loss to the market. Next, we have the Dow Jones. It dropped even more actually. So the Dow Jones went from 47,856 to 46,558. So also for the Nasdaq, you can see here, go to the Nasdaq also. So we can see that it dropped from 25,351 to 24,380, which is the biggest drop of them all. That's roughly 5 to 6% off for the Nasdaq composite. So small cap stocks were hit hardest actually. The Russell 2000 also lost about 4%. So as you can see here, 2,582 to 2,488 relative to the value of the stock. It lost so much on the last week. So it indicates that investors are moving away from riskier assets. In fact, this marked one of the worst weeks on Wall Street since October. When we see broad market declines like this across all indices, it usually signals a macro driver affecting the entire market, not just individual companies. And last week, the macro driver came from two major sources: a geopolitical tensions in the Middle East and a major spike in oil prices. So now let's move on to crude oil so we can discuss further, okay? Crude. Just type oil. Wow, a big week ahead of us. So one of the biggest headlines last week was the sudden surge in global prices. Oil price jumped dramatically at one point, crossing 120 levels per barrel, levels we haven't seen since the energy shocks of previous years. And the spike happened after escalating tensions in the Middle East, disrupted supply expectations and created fears that global shipping routes could be affected. When oil prices rise quickly, it creates a ripple effect through the economy. Higher oil means higher transportation costs, higher production costs for companies, and higher inflation pressure. For investors, This is dangerous because it creates a stagflation type scenario. Slower economic growth combined with rising prices. That puts the Federal Reserve in a very difficult position. If inflation rises again because of energy prices, the Fed may not be able to cut interest rates anytime soon, and markets hate uncertainty about interest rates. So, the second major factor that pressured markets last week was weak economic data. The latest US job reports surprised investors in a negative way. Instead of gaining jobs, the economy actually lost around 80 92,000 jobs, while economists were expecting an increase. At the same time, the employment rate ticked higher to around 4.4%. Now, this creates a strange situation for the market. Normally, weaker economic data might encourage the Fed Reserve to cut rates sooner. Because inflation risks are rising due to oil prices, the Fed may not have the flexibility. So investors are now facing a scenario where growth is slowing, inflation risks are rising, but interest rates may stay higher for longer. And when that combination appears, markets tend to move into risk of more. The sell-off wasn't limited to the US. Global markets also experienced significant losses. Developed markets in Europe and Japan dropped roughly 6% to 7% during the week, marking one of their worst weeks in nearly a year. Emerging markets also struggled, with the MSCI Emerging Markets Index falling nearly 7%. One additional factor putting pressure on international markets was the stronger US dollar. The dollar gained about 1.4% during the week. Its biggest move since last summer, by the way. And a strong dollar typically creates problems for emerging markets because the dollar dominated debt becomes more expensive, capital flows back toward the USA, and global liquidity tightens. So, last week's market environment was essentially a perfect storm of macro headwinds. So, in the next video, the seventh video of the day, we're gonna cover all the US stocks and their performance from last week, okay? But here we only talk about the impact of oil and of the geopolitical tensions and the last economic data on what's happening in today's market. So if you go back to crude oil here, you can see that we went up on the first time 180 on Monday, then we went down to 91. So just as January, we were at 30.28. Then we went up, we went back to 82, and then we went up again, up to 125 this time. A level that, if you go back on history, we may not have reached that level before. Oh, we have reached worst. Oh yeah, of course, pandemic. Wow. Oh yeah, 520 pandemic days. Yes. I remember those bad days actually, yeah. Oh, sorry. Up. So here. Okay. So, um, we'll cover the last part of this video, which is the sector winners and losers, okay? So, while most sectors declined last week, a few areas of the market actually held up better than others. One of the strongest sectors was consumer staples, which managed to post a slight gain during the week. Consumer staples include companies that sell essential goods like food, beverages, and household products. Also, investors often move into these stocks during uncertain periods because demand for these products remains stable even during economic slowdowns. On the other hand, consumer discretionary stocks were among the worst performers. These companies depend heavily on consumer spending, so if investors believe the economy is slowing, they expect consumers to reduce spending on things like travel, luxury goods, and entertainment. So, looking ahead, there are several key factors investors will be watching closely. First is the trajectory of oil prices. So, if energy prices continue rising, inflation expectations could increase again, which would put further pressure on stocks. Second is upcoming economic data, especially inflation reports and manufacturing indicators. And third is the ongoing geopolitical situation in the Middle East, which has become a major driver of global markets. Any escalation there could create further volatility. So, to summarize, last week's market decline was driven by three main forces: the sharp surge in oil prices, weak economic data, and rising geopolitical tensions. Together, these factors pushed investors into risk-off mindset and triggered a broad sell-off across global markets. The coming weeks will likely remain volatile, but for long-term investors, periods like this often create important opportunities. So, if you found this market recap helpful, make sure to subscribe and let me know in the comments which stocks you want me to analyze next. And as always, thank you for watching. Goodbye.